Warren Buffett is known as one of the world's most influential investors. Fun fact, if you invested in his company back when it first started, your mere $1,000 would have been worth over $17 million today. Now that's impressive. How did he receive such a big return? Well, Buffett has 7 principles that he strictly follows. If you want to know those secrets and strategies in investing, then you should definitely finish the whole video. Hello and welcome to Eminent Investment. Today we'll talk about Warren Buffett's investment tips for beginners. If this video interests you, do leave us a like and subscribe to the channel. If you're done with that, then let's get right into the video. Principle number 1. Have integrity. When Buffett selects people to hire in his company, he looks for certain qualities. He seeks 3 things: intelligence, integrity, and initiative. However, he asserts that the most important quality out of the 3 is integrity. Although having initiative and intelligence is important, being a person with integrity will bring you to greater heights. Principle number 2. Fact-based choices over emotional ones. Buffett noticed that a lot of investors tend to be overly emotional when it comes to investing. When bull markets happen, novice investors get excited, which drives them to base their choices on their success in the past. Because of this, they unknowingly ignore the business fundamentals that are essential for long-term growth. If you've been in the investing world for some time, you already know that savvy investors are doing well because they focus on the basic principles. Principle number 3. Invest in quality. Buffett's career is heavily influenced by his mentor Benjamin Graham. One of Graham's tactics was buying cheap stocks, which are based on quantitative analysis. This is where he came up with the cigar butt approach, where he looked for undervalued stocks, similar to how one would search for discarded cigarettes that have one last puff in them. However, Buffett says that this strategy was short-lived, as he soon realized that investing in quality businesses at reasonable prices generates more returns than betting on cheap but senseless companies. Principle number 4. Invest in businesses that you understand. Buffett emphasizes the importance of understanding what businesses to invest in. He firmly believes that one must only bet on what they comprehend, and he means this about the long-term economics of the business, not merely what the product or services are about. With this approach, he is able to make concrete decisions about the potential of the investment and its success in the years to come. Buffett predicts Wrigley Gum's future economics, and he claims that it'll probably remain steady and will continue to be a prominent contender in the chewing gum market for the next 10 years. Furthermore, he says that the internet's advent will not heavily affect the gum chewing habits of consumers, nor will it change the preference for significant brands such as Juicy Fruit, Spearmint, and Double Mint. Known as a shrewd investor, Buffett is well aware that predicting the specific numbers for Wrigley's future success is not an easy task. Despite that, he's reassured by the fact that his overall projections and analysis will be reasonably precise. He tried evaluating Wrigley's performance within his circle of competence, proving that he fully comprehends how the business operates, including its economics and competitive landscapes. His confidence in Wrigley's long-term success and the well-loved interest in its brands all stem from his sharp-witted understanding of the industry. Based on his philosophy and assessment, Wrigley falls in the scope of companies that he understands well. Principle number 5. Seize the opportunity when it presents itself. Buffett comes clean with the fact that his biggest mistake in his whole career is caused by omission. A lot of opportunities were missed because he doubted and hesitated to act right away, despite knowing the business and having it in his circle of competence. All those missed opportunities have cost Berkshire Hathaway a lot of money, which amounts to about $5 billion. He mentions that this happened with Fannie Mae, where he could have had the chance to own the entire company for a cheap price when it stumbled on a tough time. He does acknowledge that his mistake doesn't always present itself in conventional accounting, but he knows the opportunity cost of not acting on those opportunities. He stresses that seizing the correct opportunities, regardless of how big or small, is vital for success. He even goes on to say that even the smallest decisions can have the biggest impacts, and not acting on specific chances can be as essential as any big choice he ever had to make. He also advocates for making calculated and well thought out choices where investors can capitalize on opportunities that fall into the circle of competence. Principle number 6. Don't sell your businesses that easily. When it comes to Berkshire Hathaway's wholly owned businesses, Warren Buffett's approach is not to sell. He strongly believes that one should keep their businesses for the long term, and one must be dedicated to not giving them up, regardless of how much someone offers to buy them. Buffett uses examples like See's Candles, Borsheim's, and Buffalo News, making it clear that he won't consider selling even if someone offers 3 times their initial worth. He knows that this is an unconventional approach, and a lot of people may not find this reasonable. However, he asserts that this strategy proved itself to be worth it, as this is compatible with his way of life. He has all the money he needs, so he doesn't see the significance of selling his businesses. He has this mindset not just in his investments, but in his relationships as well. Buffett tends to keep long-term relationships with his business partners and employees, so it would make sense that letting go of his investments would be counterintuitive. With this mindset, Buffett creates an analogy, equating his wholly owned businesses to selling one of his children for an attractive sum of money. He claims that he'll never do this for mere financial gains. However, he does reason that if ever he considers selling a business, it'll be because he's filled to the brim with discouragement about the company's management, or if its fundamental economic characteristics change. Principle number 7. Know how to calculate the intrinsic value of a company. According to Buffett, a company's intrinsic value is an estimation of its prospect cash flow minus what it's worth at the present time. He further adds that the main purpose of investing is to bring out your money in exchange for receiving it in the future in a much bigger amount. When it comes to analyzing stocks, looking for a company's intrinsic value is way more complicated than with a bond, where the cash flows are easily stated. However, when we're talking about stocks, analysts must roughly calculate the future cash flows the business will have. The analyst must look into factors such as the operations of the company, its competitive advantage, profitability, and its management efficiency in estimating future cash flows. Every investor must understand the intrinsic value, regardless of how big or small their investments are. Buffett emphasizes that one must always consider how much profit a certain investment will generate in the future, and whether the initial purchase can be justified in the succeeding cash flows. Furthermore, he explains that another vital aspect in determining the intrinsic value is the discount rate, which signifies the opportunity cost or the cost of capital. The longer the time horizon is, the lower the discount rate's impact on the current value diminishes. Buffett strongly believes that the most important guide to making investment decisions is to calculate the intrinsic value of a company. This is way more important than focusing on other factors like stock volumes, market trends, or analyst recommendations. He even applies this approach to buying businesses, seeing each purchase as if he's buying a whole company. Buffett tends to assess whether the cash the business will generate in the future aligns with what investments he's considering. Buffett is well aware that the 7 principles he's mentioned may seem simple. However, most investors struggle to adhere to the basics because of how saturated the market is. It's also quite easy to get lost in our own erratic emotions. Nonetheless, keeping this rational guideline in the long term can pave the way to getting high returns in one's investing career. That's it for today's video. If you liked our content, do give us a like and subscribe to the channel. Once again, this is Eminent Investments. Thanks for watching, and we'll see you in the next one.